Hello and welcome to today's Space to Grow webinar, where we'll be looking at tax and specifically SEIS and EIS and the tax benefits that can be gained from those. I'm joined today by two expert speakers from the world-renowned firm BDO in Peter Harrup and Colin Downing. So Colin is an associate tax director at BDO and Peter is a tax partner at BDO. So really, we've got the best of the best for today's session. So just before we get into that, a little bit about myself and the program. So I'm Josh Clark. I'm the business support coordinator at the University of Essex and overseeing the Space to Grow and Angels at Essex programs. So Space to Grow is what this webinar is part of, and that is a series that helps entrepreneurs and investors get investment ready for a series of webinars covering all things from tax, like this one today, all the way through to things like pitch decks and social media to give you a really good footing in your investment readiness journey. And the Angels at Essex platform is our equity investment platform where investors can connect with innovative businesses who are looking for funding. For more information on Angels at Essex and Space to Grow, you can find that on our websites or through our social media, which is at UEZ Space to Grow. All of our webinars are recorded, including this one today. So if you want to run over the expert knowledge again, you can do so by going to the Essex Startups YouTube channel. Okay, so as I've said, today is all about tax, and we'll be covering very important topics. And tax can be a really difficult one to get your head around, but it's really important that you have a good grasp of it for your business, and also if you're looking to invest in business as well, because you can get some really good benefits from some of the schemes available. What I'll do now is hand over to Colin and Peter, who will be taking the session today. Thanks, guys.
Thank you, Josh. My name is Colin Downing, and I'll be taking you through some of the more detailed points in relation to EIS, which is Enterprise Investment Scheme, and the SEED Enterprise Investment Scheme, which is the youngest son or sibling of EIS, which is for smaller startup companies. We'll look at what's in it for the investor. We'll look at the pitfalls, company requirements for the schemes, including knowledge investment companies, and how you can actually get the reliefs that are available. So hopefully my system, yes, there we go. So background to the Enterprise Investment Scheme to start with. It was introduced back in 1994, so it's been around now for some 26, 27 years. And in that time, more than 28,000 companies have received in excess of £18 billion worth of investment. So there's a lot of money that's out there that's come in. The SEED EIS scheme started back in 2012. So that's been around for 8 years plus now. And that's principally for startup companies, smaller companies. And we'll come into some more detail on that a little later. And then I'll touch on VCTs, which are venture capital trusts. They cover startups all the way to an AIM listing. So what's the purpose of the EIS scheme? Well, it's to encourage UK investors to invest in equity, that's shares, of unquoted trading companies. And in return for that, the government have basically given you some tax benefits, some upside benefits as well if things go really well, and to help out if things don't go so well and maybe the business gets into difficulties. It also is there to help basically unquoted companies raise finance, which they envisage as being the funding gap. So here's a brief table which you may find useful to refer back to in future. It covers in very simple terms the tax reliefs, how much you can invest, benefits, etc. In relation to each of the three schemes that I've just mentioned to you. So you'll find that useful. I will cover these in more detail now. So investor tax release, looking at the investor release in more detail. There are some catches in there. So first of all, we need to make sure that the individual is not connected with the company. And by connected, we means must not be an employee, You can be a director, but be very careful if you're in this situation, because you are subject to what they call the angel rules for EIS, and there's some very strict rules in relation to that, which I'll come on to in a minute. And you mustn't have held or hold more than 30% of the shares in the company, and that includes certain relatives as well. You mustn't have any related investments arrangements. So in other words, we can't have a situation where you invest in my company and I'll invest in yours, for example. No linked loans, so don't have a loan which you then convert into shares, although I will come on to the future fund in a little while. No tax avoidance motive. So in other words, you're not just going into this just to get the tax reliefs that are available. That would be unusual, to say the least, because normally you would invest in a company like this because you're looking at the company actually going to make a lot of money from it, and you want to recoup your investment and some at the end of it. No value received from the company apart from a normal market rate of remuneration. The EIS investor mustn't have any other shares in the company that they're investing in, apart from possibly some previous EIS, SEIS, or VCT shares. So we need to make sure they haven't got any other ordinary shares in there first, which then precludes you from getting further EIS, etc. shares. If you have EIS shares and then you acquire other non-EIS shares, that's okay, but you won't then be able to get any more EIS shares after that. And one trick in there is you must claim some income tax relief in order to get the capital gains tax disposal relief, which I will come on to in a minute. Income tax relief can be as little as £1, but you must claim some of it in order to access those capital gains reliefs. So what are the reliefs? First of all, income tax relief at 30%, that's up to £1 million of investment. If it's a knowledge intensive company, then the investment can be up to £2 million, and it's a flat rate, 30%. You can have carryback of the relief, carrybacks the EIS relief that you get into the previous tax year if that works better for your income circumstances. So if you have a small amount of income this year and you've put in a significant investment, you might want to carry it back to the previous year so you can make full use of that 30% income tax relief that you're going to get back. And you can reduce your tax bill to zero, but you can't go any further than that. So if, for example, you made a £100,000 investment, which would give you 30%, £30,000 tax relief, if your tax liability for the year was only 24,000, that's all you're going to get back. You can't get the extra £6,000 if that's not your liability. So looking at the EIS release in further detail, the gains that I mentioned just now. So if you acquire some EIS shares, you paid say 100,000 for them, and the company does really well and sells out in say 5 years' time, and you make £200,000 for your shares that you paid 100,000 for, that 100,000 gain will be fully exempt from tax. So no matter how big that is, whether it's 100,000 or 100 million, it's still tax-free, providing all the rules have been adhered to. And it's important that all the rules are adhered to, not just at the beginning, but all the way through at least a period of 3 years. And also assumes that some income tax relief has been claimed and not withdrawn or clawed back by HMRC. As I said before, we must ensure that some income tax relief has been claimed, even if it's only £1. And if you have to disclaim your personal allowances to make sure that that happens, then that's the way that you should do it. Watch out for claims against income with lower rates of tax. So if you have got lower rates of tax that are being charged in this year, as I said before, you might want to carry the relief back if you've got high rates of tax charged in the previous year. So it's worth planning any EIS investment that an individual makes with reference to the income that they have or have had in the previous tax year. There are also some other reliefs that you can have for capital gains tax. So you can defer capital gains. Now this is slightly different to not having to pay it. So if you have a gain on another asset, then you can defer that into your EIS investment. If that gain is made 1 year before to 3 years after your actual investment is made, then you can defer it in there. What happens is when your EIS investment comes to its end, so when you either sell up or company goes into liquidation, then that old gain will come back into charge and you'll need to pay the tax on it at that stage. In this particular case, for deferral relief, there's no £1 million limit. There's no 30% limit on shares. But as I said, the gains do come back into charge. So that can be quite useful, but it's only delaying the inevitable day that comes back. If you've got a disposal that you've had where you've had entrepreneurs relief, then that can be okay, but you need to look at that closely because hopefully the 10% will come back and recrystallize at the end of the day. But you do need to be careful, particularly if your historic gain had higher entrepreneurs relief than what may exist when the ultimate gain comes out at a later date. So loss relief, as I said towards the beginning, there's some help if things don't go as you plan and you've put your investment in, you put your £100,000 investment in as an example here, you've had your income tax relief at 30%, so that's 30,000, that's good news, but then the whole company is basically crashed out, not done very well, and lost money, so ended up being either liquidated or just struck off. So in effect, you have lost all of your what was £100,000 investment, although you've had 30k back by income tax relief. So you're still out of pocket by £70,000. So the government will say, okay, you've made a loss of 70,000, so you can have some loss relief there. And if you're paying tax on your other income at 45%, then that can equate to tax relief of 31,500. So your net loss would only be at 38.5%, i.e. 38,500. So not quite as bad as it might otherwise have been if you were just investing in a normal company that then didn't do so well. Obviously, if you deferred a gain into your EIS investment at the beginning, then that deferred gain will come back and become chargeable on this occasion. Inheritance tax, business property relief, or BPR as we often shorten it to, it's not specifically an EIS relief, but as this is a trading company, any EIS qualifying company should also qualify for BPR at 100%, so there shouldn't be any IHT, that's inheritance tax on death, providing you've owned the shares for a minimum period of 2 years. So SEIS in brief terms, because most of it is very similar to EIS, it's just there are 1 or 2 differences to it. First of all, the income tax relief is a bit better here. So instead of 30% income tax relief, we're going to get 50%. So that's even better than the maximum tax rate of 45%. It is a flat rate of 50% of your investment. And that, again, if you want to carry it back to the previous year, you can do that. However, as it's a young sibling, there are limits here. The maximum you can invest in an SEIS company for an individual per annum is £100,000. Limits on the company, it must be under 2 years old. That's from the date of first activity. What I would suggest in practical terms is it's a lot easier if it's actually less than 2 years old from the date of incorporation, and then we don't end up in any arguments with the revenue about activity and when that actually started. Once again, capital gains on sale of the shares, providing you've held them for the relevant period, are exempt, so no tax payable on sale, no matter how large that gain is. And slight difference here is you've got another gain on something else, which you are then investing into your seed shares. Then you can get what's called reinvestment relief, effectively of up to 50% on the gains. This is not a deferral. The gains are effectively being reinvested in here and effectively get rolled into your shares. Income tax relief, as I said, is either in the same year or you can carry it back 1 year if that works for you. So business angels and EIS. I mentioned earlier about certain individuals being paid as an employee, providing you meet the business angels rules. So company directors do not qualify for EIS unless they meet these business angel rules. In effect, that means that they are either unpaid or not entitled to remuneration. So you can be therefore a director but not entitled to any pay at all. Or and in addition to that, you mustn't be a director before the first EIS investment, and you must meet various other conditions, which I'm going to come on to now. So there are some permitted payments that can be made to an individual. First of all, necessary expenses. So in other words, if you have personally incurred expenditure in relation to the EIS company, then of course you can be reimbursed for those necessary expenses. If you are providing, for example, premises or something along those lines, then you're allowed to have a commercial rate of rent or interest if you're lending money, etc., for goods that you provide. So that's reasonable. You can have reasonable remuneration providing it's paid for services rendered in the course of a trade or profession other than secretarial or management services, or services of a kind provided by the person to whom they're being rendered. So there's a bit of a mouthful there, but in effect, if, for example, the SEIS company or EIS company is, say, a travel agent, and you're investing in that company, then providing you're not also a travel agent, you're something else, then that should be fine. So if you're a plumber and you gave them some help with some leaky pipes or something like that, that would be fine. But if you're also a travel agent, then you couldn't be paid even a reasonable level of remuneration for those services that you're providing. Of course, as ever with the revenue, any expenditure like this in the EIS company has to also be taxable in your hands and not, should we say, cash in hand and not appearing anywhere. The other issue which we do come across sometimes is you need to watch out for payments to connected individuals, including a personal service company, as this will be treated as a payment to the investor, can be treated as receipt of value, and then knocks out your income tax relief and all the other reliefs that go with it. So, for example, if you have a grandson who's perhaps in holiday time looking for a bit of a job, and you have a word with the director of the EIS company and say, look, grandson could do with some work for, pay him £100 a week or something, just doing some admin work, that will mess up your EIS relief. So make sure that no connected persons are also being paid for work in the company. In addition to that, you must not get any remuneration or be entitled to it before the first EIS investment. So you can't have been a director or an employee, get paid, go away, come back again, and then do your EIS investment. Once paid, further EIS investments are okay if within 3 years of the last EIS investment before you're being paid. So, for example, if you have an EIS investment, shares are issued on 1st of April 2020, you become a salaried director on the 1st of May 2020, The final date for any further EIS investments that you make will then be the 31st of March 2023, because it's the 3 years period starting from when the first EIS shares were issued. So watch out for that one as well. Various pitfalls for EIS investors. You must not hold any non-EIS shares in the company, as I mentioned before. The shares must be a subscription for new shares. So you can't buy EIS shares from someone else who already owns them. It has to be a direct subscription for EIS shares with the company concerned. Watch out for associates, because here you can get disqualified if the individual is an associate, or an associate is an employee or director of the company, as I've mentioned. And watch out for investments that exceed the various limits. And I've covered the example already of the grandson there, so that's there in black and white if you want to come back and have a look at that at a later date. Other pitfalls, there are lots of detailed rules here. So investors and associates not owning more than 30% of shares, not being an employee apart from the angel rules that we've covered. The rules don't just stop when the investment's made. It goes on for a period of at least 3 years. As far as the company is concerned, it needs to watch out what it uses the EIS and SEIS funds for, because it has to be qualifying trading activity, not buying something like a subsidiary company or something like that. Another thing to watch out for is the timing. So the company receiving the cash has to issue the shares at the relevant time, rather than issuing the shares and then receiving cash, for example. So it has to get the cash first. And another one to be very careful of is where the company is doing one particular task or development of a certain business material, etc., and then changes that because it doesn't work very well. As long as it's in the same area and you're just developing, it's evolving, then that's fine. But if you totally changed, then that might, particularly if you change into one of the non-qualifying areas, can be difficult. Watch out for restructuring. You need to take proper advice here, because if you're restructuring the company, then it can disqualify EIS investors, so we need to be very careful and watch out for interacting with other share schemes. So as a company evolves and gets bigger and bigger, it will want more and more money and starts taking investments under other EIS or other certain share schemes that are out there. So the absolute rule here is talk to your professional advisors before doing anything along those lines. So qualifying companies, basic rules, the release are intended here for riskier investments into UK unquoted companies. So companies must meet the following criteria. They're going to be unquoted, and here AIM, the alternative investment market, is treated as being unquoted here. Trading company, so not an investment company, has to be wholly or mainly in the UK though. Watch out for the age, so for SEIS under 2 years old. The gross assets limit, so we've got 15 million here before the investment for EIS, and 16 million after. So at the moment it's not going to be an issue, but as the company evolves and gets more and more bigger and starts to build up its assets, then watch out for that. And it is gross assets, which I will come on to in a minute. Independence and qualifying subsidiaries. So the company needs to be independent, not a subsidiary or under control of another company. It can have qualifying subsidiary companies. So as it evolves and gets bigger, it can put some of its trade into other subsidiary companies if that's the way it works. There are also number of employees limits and excluded activities, which I'll come on to in a minute. So in brief, there's a table here just showing the various age of the trade. So SEIS was 2 years. For EIS and VCTs that are non-knowledge intensive companies, you need to get the first EIS investment in the first 7 years. After that, you can carry on and get further EIS after that. But if you get to more than 8 years before you ask for the first investment, then you're automatically going to fall foul of that particular rule. If it's a knowledge intensive company, then that time is 10 years, not 7 years. As I mentioned there's gross assets investment. So that's gross assets, not net assets. So liabilities are not taken into account there. And you just need to be careful, particularly for SEIS companies or maybe EIS companies, if you're buying in intellectual property or having to pay for it or generating it, often that's left off of the balance sheet and can be quite valuable. So watch out for that. I mentioned there numbers of employees and the maximum investments that are available. You can refer to those if they're relevant to your particular circumstances. So the age requirements, as I said, SEIS companies 2 years old, EIS must be less than 7 years old. Again, from the first commercial sale, but it's often easier if it's from incorporation. There are exceptions for situations following funding or entering a new product or geographic market, but that's often very difficult to persuade the revenue that that's what it relates to. But it is possible to do that if you've got into a totally new product and market area. Knowledge intensive companies, I'll come on to in more detail of what they actually are a bit later. So just quickly rattling through these, again, it's gross assets for SEIS companies of £200,000 is the limit. If it's above that, then you're going to have to look for EIS relief, not SEIS relief. For EIS and VCTs, it's then gross assets of less than £15 million before the share issue and then 16 million immediately thereafter. As I mentioned earlier, there are some excluded activities from all of the three schemes there, which is fairly prescriptive, dealing in land, shares, futures, etc., financial instruments, banking, just to whiz through some of these, so accountancy services, property development, hotels, nursing homes, etc. The main reason for these is that the revenue don't consider these are either risky enough or in general what you will have is an asset base which is more secure than other areas of actual business development. One area to watch out for is license fees. So the receipt of royalties and license fees is an excluded activity unless the company issuing the shares has actually created the greater part of the value for the intellectual property itself. So it's possible here for the company to actually generate a whole new widget which has got intellectual property in it. It then licenses that IP out to somebody else and then gets some royalties for it. That's okay, but if it's just paying royalties out so it can trade, that's not allowed. But there is a 20% tolerance for non-qualifying matters in general here. So, and I will come on to that in a minute. Okay, so the 20% tolerance, a company which carries on any activity can have an excluded activity within it, providing that element makes up less than 20% of the company's overall activity. And that's measured by what we call the most appropriate measure. So it could be turnover, it could be profit, assets employed, etc. The problem here is that the revenues approach is that they will look at the company, and if any one of those measures exceeds the 20% limit, then that disqualifies it. So you need to make sure that all of those particular measurements are under the 20% limit. Otherwise, you could fall foul of that. So, for example, if you normally manufacture widgets for sale and then you add leasing of widgets, then lease a different product, then you may find that different product means that you fall foul if it goes above the 20% limit, which is not related to the EIS trade. Mentioned earlier, the 3-year qualifying period. So the company needs to meet certain criteria, which includes throughout a period of 3 years, it has to have the qualifying trade. It has to be meet the independence and qualifying subsidiaries rules. So in other words, it mustn't be controlled by somebody else or another company, and all its subsidiaries, if it's got them, are qualifying. The rules apply on the date of the share issue and for the next 3 years. So not just on the date that they're actually issued. Rules that apply only on the date of the share issue are in relation to the number of employees and gross assets test. So if you meet the number of employees test on the date that the shares are issued, and then you take on a few people the day after, which sends you over the limit, that's okay, because that's to do with growth, and quite often you'll be obtaining funds in order to grow the company and take people on. But it's important that you make sure that you do meet those tests beforehand, and then you can exceed them afterwards if necessary, if you get to that size. One thing to watch out for is qualifying companies cannot trade in partnership with others. Joint ventures can also be problematic because the revenue can look at those and say, well, that really is just like a partnership, which in certain guises it can be. So we need to watch out for any partnership agreements, and some can be for the supply of services. So it needs to be very carefully worded, and you do need professional advice in relation to that to make sure that the revenue are not going to look at something and say, well, that's a partnership agreement, rather than the company working on its own. The risk to capital requirement emerged probably 3, maybe 4 years ago now. Time flies by, but this came in, and it was principally brought in because of Europe. So whether this one hangs around for much longer remains to be seen. But the revenue were very strict on the requirement for a company to demonstrate genuine commercial risk. So it must have objectives to grow and develop in the longer term. The investment itself must have a significant level of risk in it. And in practice, not usually an obstacle to early stage entrepreneurial trading companies, but as I say, you need to be able to demonstrate that there's a commercial risk to someone investing in the company, which is why, as I said earlier, if you've got a property development company or something like that with assets that are going to keep their value, that's not high risk. This needs to be something generally that is either new or something that is of significant risk to the investor, that they could genuinely lose all their money before the company then eventually goes under. So there has to be an element of risk there. This will be useful to those who are not sure, and for those who think they have got a knowledge intensive company, to make sure that they actually fall within those rules, because there are more generous age and size limits for knowledge intensive companies, or KICs as we often shorten them to. So what is a knowledge intensive company? Here we're looking at, start looking at costs. So 15% of the costs must have been spent on R&D, that's research and development, in one of the last 3 years, or at least 10% of costs spent on R&D in each of the last 3 years, and It must be engaged in work to create intellectual property, and it must be reasonable to assume that within 10 years, most of the company's activity will consist of exploiting that IP, or at least 20% of the workforce are skilled employees. Now, skilled employees here means that they must have a master's degree or higher and are directly involved in the research and development that's ongoing. There are special rules for companies which are less than 3 years old in this situation as well. So how do we actually get access to the release, etc.? Well, the revenue helpfully do have an advance assurance system. So in essence, what we can do is apply to HMRC for an advance assurance that they think we comply with the rules and that the company's doing a qualifying activity, etc., and that anyone investing in the company should then be able to access the EIS or SEIS tax reliefs. This isn't compulsory, but we find that most investors and fund managers, etc., will insist on it. It is beneficial because although you can't undo issues later on, once you have got the advance assurance, then people quite often are more likely to invest in your company. It also deals with a possible risk for directors. If you haven't got advance assurance, people then invest on the understanding they'll get EIS and then it doesn't happen. So it does give some level of comfort on getting an advance assurance. Most companies will start with an advance assurance application, which involves completing an online form now, a whole bunch of checklists. We need to send this to the revenue with a business plan, includes financial forecasts for at least 2 years, budgeting, setting out what you'll be spending the money that you get from SEIS or EIS, what you're going to spend it on. We need to give them a set of the company articles, any shareholders agreements, and also the last one there, which can be a little problematic sometimes, is a list of the intended investors. If you've got a number of investors or potential investors at the time we're doing the advance assurance, then that's great. There can, of course, be others that come along later, and there can be some that drop out. But the revenue just want to really have a look at and see that you're making a serious application and that you're just not playing the field, so as to speak. So once we've gone through the advance assurance, you've got the advance assurance, everything's great, you've issued some shares, what happens then? The company submits either an SEIS or an EIS1 compliance statement to the revenue, basically saying, yeah, everything we said when we got the advance assurance, we are now doing. That's not complicated, it's relatively straightforward, providing you've done and got the advance assurance. If you haven't done the advance assurance in the first place, then everything that we would have done to get the advance assurance, you will have to do here as part of that compliance statement going through to revenue, as well as filling out that EIS or SEIS1. Providing everything's okay, then the revenue will issue what's called an SEIS or EIS2 form, which confirms you meet the compliance requirements, and they'll also send you the relevant number of SEIS or EIS3 forms, which are for the shareholders, the people who have actually invested in the company. Now, there are a couple of bits of information that are on the EIS2 form, which you'll need to complete on the EIS3 forms. And then there's a second half of that form, which you then give to the shareholder, and they complete that second half of the form and claim whichever release they want and how they want to do it, and in relation to whatever years is relevant for them. Let's see what else we've got. Okay, so one problem area you can have is if you've got a holding company that gets EIS relief and then puts some money into a qualifying subsidiary, they'll need to lend it only And even then they can have issues. So you need, if you're going to be in that situation, you need to speak to your advisor, because investing in subsidiaries is not always a qualifying trade. Active subsidiaries using EIS, the subsidiary must exist when the shares are issued, but can be dormant until later on. So if you're going to have a larger group structure, then by all means have a dormant set of companies rather than creating one later on. And then the spending of the cash. So the rules in relation to spending the cash for SEIS are that you have to spend the money on qualifying acquisitions or activities. In EIS, it's employed in the business. So it's slightly different there, which allows a slightly wider interpretation of how the money is actually spent. So what else have we got? Needless to say, these reliefs are valuable tax reliefs. So there are complexities, and there are some more complex areas that I haven't gone into today. And the rules do change. So interpretation of those rules can be very important, and what might work or not work today might be different tomorrow. Obviously, BDO have got a team of experienced tax professionals in this area, which deal with this day in, day out. So we're here to help if you need help in that area. The other thing I have mentioned is we've gone through a lot of the EIS and SEIS rules are in relation to state aid and were previously regulated by Europe. That shackle has obviously now been removed. So we could find that the rules are eased or indeed tightened. And of course, everything that I've said today could be absolute rubbish in a week's time when the budget's happened and everything else changes. So as I said there, it is a state aid issue which will now change. So everything could change after 3rd of March. And just in case there are any issues, then there's our disclaimer in microscopic writing so you can't read it. So if anyone's now got any questions, then if you want to fire them through, we'll do our best to answer them.
Thanks for that, Colin. So first of all, so we spoke about, you touched on the 2-year rule for EIS, SEIS.
Yeah.
How flexible is that in terms of the date of incorporation, or is it the date of trading, and how likely is it to be SEIS approved if you're older than two years?
So if the rule is actually first activity. So if you started your company and done absolutely nothing for 12 months, and then a year and a half later you want some SEIS, then that's fine. You should be okay with that, providing you can demonstrate that your first activity was not more than 2 years before the date that you're applying for it. It can be very difficult because one person will say, "Oh no, I wasn't doing anything," and then when you look at the paperwork, or they were perhaps searching the internet looking for certain business areas that they might start up in, or checking footfall in certain shopping areas or something, then that's potentially an activity. They're doing something before they then decide how they're going to proceed. So doing nothing is the safest way, and absolutely doing nothing is the only safe option there.
So any kind of work at all could be classed as
Absolutely. Yes, any activity can be regarded as doing something rather than nothing. Yeah.
Okay, thanks for that, Colin. Got a couple more in here as well. We'll go with this one first. So, do you need a lead investor to apply for advance assurance? And what happens? Or is this even a possibility? Are you able to apply for it if you don't have any named investors or potential named investors?
It's about the revenue do ask for a list of investors. So I would have at least one, even if it's the lead investor there in the first place. It's helpful if it's a lead investor, because that tends to be a reasonably substantial amount that they're going to invest. You don't have to have advance assurance first. You can do it, as I said, without advance assurance. It, in practice, takes a bit longer, because if you've got advance assurance, then most of the boxes are being ticked, and you can then just say, well, okay, we've done this last bit. They've actually paid their money. Can you just nod it through, and that's fine. Whereas if you haven't had the advance assurance, they've got to do all those checks, and sometimes do ask questions, particularly about cash flow and projections and business plan, etc. And they do search the internet and check out Google, etc. And it can raise a number of queries before you actually get to the end result. So yeah, just be careful of that. So it's not essential to have advance assurance. It is essential to have at least one potential investor in there. I have seen it where the named investor they've put in the initial application has gone in there, the revenue had done the advance assurance, said yes, and then that lead investor's actually decided not to in the end, and someone else has come in. So it doesn't mean they have to invest. It just means that there has to be someone who's at least seriously considering it at that point in time.
Okay, so there's no room for a speculative advanced assurance application, or
No, the revenue do not like speculative advanced assurance. They consider it that you're not seriously looking and considering the business, not looking seriously at trading, and therefore, if you haven't got proper investors in there, don't waste our time. They've got scarce resources as it is, so they really don't want to be wasting their time looking at someone who then says, "Oh well, I don't need it now. Thanks very much."
Okay, brilliant. And there's a follow-up one actually, which is similar, around, for advanced assurance, do the investors' names need to be based in the UK, or does that not matter?
They have to be UK investors. So yeah, if it's an offshore investor, whilst they might be more comfortable that it's an EIS company and therefore meet certain criteria, they won't be able to access the tax reliefs that are there. So there's no point in an offshore investor saying, yes, I'll have this, unless perhaps they're thinking of coming to the UK and then they make their investment once they're here.
Okay, great, thank you. I don't know which one of you wants to answer this one, but this one's in relation to the future fund and convertible loan notes. So in the following situation, a current investor holds EIS shares. Investors participate in a future fund's convertible loan note. At the next funding round, when the convertible loan note converts into equity, these new shares, will they be EIS eligible or not?
I'll pick that one up. So the future fund will convert into normal equity. So at that point, the investor will then have some historic EIS qualifying shares and some non-EIS shares which originate from the future fund. And that's fine. However, it can become problematic later on, particularly if they want to make further EIS investments. And we would need to look at ways of changing that situation, because you can't have non-qualifying EIS shares when you're going for some further EIS shares. So there are a couple of ways you can do it. Potentially you could pass all of your existing shareholding over to your wife. That could work, and she's got it, and then you can invest further in EIS shares. Or you could dispose of all your existing shares if they would qualify for the relevant release, etc. And then you got nothing, so you could then go and buy some more. And there are various themes looking around how you can get rid of the shares or move them on. The problem is, if you're going to sell them, you'll need to sell all of them, because they're all in effect blocked together. So you can't just say, oh, that bunch over there was my future fund shares and I've still got my EIS ones. They're all merged together, unless you happen to have a slightly different class of share, in which case, if the future fund shares were, say, B ordinary shares, and all the other EIS shares were and all the other shares were A shares, then you could sell your B shares. and then not have any non-qualifying shares that way.
Okay, thanks for that. And I guess a follow-up from that then, with convertible loan notes, is it advised to avoid them if you're going for any sort of SEIS or EIS funding, or as you say, there are solutions where that
I think
can
we
be.
find, Colin, wouldn't we, with particularly with most of the businesses that we are talking to with SEIS or EIS, until the Future Fund came along, we didn't really look at anything that was convertible.
No.
So you would typically look for shares, and you wouldn't be talking about converting loans. I say that it's only that. I think it's something of its time. They've just come to an end. So whether we see them in the future, it would be surprising. But certainly we do a huge amount around this, and there are sort of lots of stock questions. I'm happy to throw a few out there that we normally come across.
Yeah, please do.
For example, the classic would be either husband or wife owns 100% of the company and then says, I want to introduce my spouse or children into it. Would they qualify for EIS because they're going to hold less than 30%? And the answer to that straight away is no, because they're connected. So basically you go up and down. So you can't give it to your parents and can't give it to your children, but you could give it to your brother or sister. Now, we have the conversation because we have to have full disclosure, but as soon as you say to anybody, for instance, I want you could give 25% of the shares to your brother. Whilst in theory it works from a tax perspective, I've not seen it happen yet because nobody's prepared to let their brother or sister gain from their own business. So it's an idea, but like I say, we have these questions on a regular basis. If you're looking to get EIS, it needs to be a third party. And the other one is that if sometimes we have a number of shareholders that we're all going to go in at the same time, it's not untypical to have one that has the cash, one that's borrowed the money, one that's getting money from a number of the family, and somebody else that's got a combination of the three sources. Often the person that's borrowing is last to the party. So suppose there was 4 of them and they're all going to get 25%. The day that they are supposed to sign the share certificates, they all roll up, but the person that's borrowed hasn't got the money. They all issue their shares, and funnily enough, the 3 that have the money get 33% of the shareholding, and immediately they've fallen foul of the EIS rules. The one that comes along fourth gets the EIS. So it's well, sometimes the advisors seem to be pedantic. We've sort of seen a lot of the things that can happen. And it's sort of a case of it, providing you sort of follow your advice and do everything in the order that's supposed to happen, you will get the reliefs that you're seeking.
Brilliant, thanks, Peter. Just a couple more questions to go through here. So this one on, again, is another one on advance assurance in terms of, is a refusal to provide advance assurance by HMRC reviewable, and what's the best course of action in such circumstances provided to the criteria are met?
Tricky situation there. I have seen the revenue do tend to dig their heels in on certain pedantic points when you think that you've met all the criteria. Clearly, if the revenue have refused advance assurance, it doesn't mean that they're necessarily correct. So if you are very, very sure that you are correct, then you can take the risk and go for trying to get EIS approval from them once the investment's actually made. And I have seen a situation where advance assurance was refused, and then the application was then made, and it was successful after a bit of argument, purely because the initial officer misunderstood a certain situation that happened not to be the case. And because they dug their heels in, they weren't going to listen to anything else that was then said afterwards, which was less than helpful. But it's sometimes helpful when someone else picks it up and looks at it afresh and then goes, oh yeah, it's not an issue, so that's fine. Yeah. But there is an added risk that if you've been refused, then you won't get it in the long run. So you do have to be very sure of yourself or willing to accept the risk that will not happen.
Yeah.
I think also in the revenue's defence, they've probably been one of the easiest to talk to through the years, haven't they, Colin?
Mm.
So we've had lots of discussions with them, and where we haven't been able to perhaps explain as well as we could do in the letter what the real issue is, we've spoken to them on the telephone. And once they've understood what the position is, often you can get them to give you the assurance, not because you're trying to be clever, but just because, you know, it's a particular set of circumstances that looks as though it could fall foul. We all know that sometimes people get the wrong end of the stick through nobody's fault. But when you talk to them, but we've certainly had cases in the past that wouldn't fit squarely in it, so that, you know, everybody would recognise it. But we do think that it does fall in. A classic one we had was, for instance, wine, where you can't get it if effectively you're holding wine for investment, so you're effectively settling it down, but you could if it's effectively drinking wine. So we just needed to get them comfortable that it was the latter and not the former that we were dealing with. But it was much easier to have the conversation with them over the telephone in that particular instance, and then find out what the issue is. And if nothing else, it then gives you an opportunity to truly address their concerns and put them in writing and get you the assurance that you want.
Great, thanks, Peter. So I'm aware that we've just ticked past 3 o'clock. I can see there's some suggestions that maybe we should have another webinar after March to see what's changed.
Yes.
So we might have to bring you both back for that one. But for now,
I'll say one question that sometimes gets asked, Josh: is it worth it? Because obviously there's costs attaching to it, and certainly in our experience, we would say yes. I think it's easier to attract investment if it gets the tax relief that goes with it. And I suspect you'll find in the budget that there'll be more opportunities for people to get tax reliefs investing in businesses that will grow. So I don't think that you'll find less. This is my own personal view. I think you're going to find that there'll be more opportunities for investment and more opportunities to grow, because that was one of the reasons for coming out of Brexit, wasn't it? Certainly Boris Johnson was very keen to invest in the technology sector. So I think it's worth it. We do accept there's a few hurdles to jump over and hoops to go through, but I think it's well worth it, typically because a lot of businesses will not just go for one funding. They'll probably go for a second or even a third fund. And if you've got the EIS relief, it makes it a lot easier.
Thanks a lot, Colin and Peter. It's really, really useful and really informative stuff. And we'll have to get you back for after March the 6th, was it? So a third, that's it. So this has been recorded. So if you do want to watch it again, it will be on YouTube. And I know there's a lot of detail there, and we will share around the slides as well. And are you happy for people to get in touch with you, Colin and Peter? I know your details are on the slides. So if you have any further questions, you can look at the slides, get the info, and fire across your questions. And if you've got any more questions about the work that we do at the University of Essex through the Space to Grow or Angels at Essex platform, please do email us at uez@essex.ac.uk. But for now, I think we'll leave it there for today. So I just want to say thank you again to Colin and Peter for taking time out of your day to be involved. And yeah, we'll see you all next time.
Thank you very much.
Thanks, everyone.
Bye-bye.